Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, December 17th, 2021. It's just after 10 o'clock Eastern Time as I'm starting the video. I wanted to wait and see how markets opened, how things got underway. I did respond to the questions on the previous post from last night, so you might want to go and check some of those responses there. A couple questions on folks, where to short, what to look for, and I'll talk about that in this video. All right, so what happened today? We did gap down. It wasn't, well, here's the thing. We gap down, so if you want to play it this way, let's just pick it apart and analyze it. Certainly bearish anytime you gap down. Like obviously, it's bearish. But again, what did it change? Well, one thing it did, it wiped out all of the what I call the post-FOMC rally. We had this right here. That's the rip, that 3-point-something% rip after the Fed announcement. And so by gapping down, I mean, even yesterday we came close, but today the gap down had wiped out every inch of that and then some on the gap down, but we're right about back to where we started. Either way, my takeaway, again, I have to throw a little caveat out there. I try not to read too much into any one day's price action, because like I like to say, one day doesn't make a trend. But if you want to kind of dig down and get granular in the charts, then what that did is it wiped out all those that bought, individuals as well as institutions that bought the Fed announcement, thinking that that would be bullish for stocks. Who knows? And only time will tell if it was the fact that the Fed had a choice, or I'm sorry, had an option to be more aggressive, but didn't take that option. Yes, they're continuing to wind down their bond program, but again, there no rate hikes at this point in time. And again, I've always said the Fed is reactive, not proactive. They've already changed their tune, as I said they would, from where they were a year ago when they had rates not being moved for a long time and keeping the pedal to the metal. So again, we're seeing them, turn. They're not going to pull a 180. The Fed will not do that. Today's Fed will not do that. They don't do intermeeting rate cuts. Wouldn't be surprised to see one over the next year or so when things start to get ugly. But the Fed of today and in recent years is one of, in my opinion, excessive transparency. Markets want transparency, but too much is good, because then the Fed, once they realize they're wrong, as Powell's been, it takes him a while. He's got to turn the ship slowly, like a tanker. He can't turn around like a center console or a powerboat, turn quickly. And sometimes you need to do that when conditions warrant. So this is the path they're taking, like a tanker taking a slow turn. And again, we'll see if it works out. Maybe it does. Maybe Powell knows what he's doing. All right, that's it. I just want to say that that's what the gap down did today. But then bigger picture, we look at where we gap down to, right back to that 380-280 level. So to get back to the question of where to short. Look, I think we're going down there, and if I mentioned someone who didn't, someone said they didn't short there yesterday. If you don't have any positions, again, I'm just talking what I would do. It doesn't mean it's right for you. I would start scaling in now. Now it is a little bit contrary to TA 101 in what I often say. You don't. Usually it's not a great idea, and I'll even say it now. You could hold off. It's not the best idea to short a pullback to support. If anything, that's an objective long entry. And I'm going to say it here for those that are bullish and acknowledge that, look, only guarantee I ever give you in technical analysis or with this site or in trading in general, I don't care who you are, but I'll give you my word, is that I promise you, the only guarantee I'll give you is I'll be wrong, and I'll be wrong a lot. Hopefully I'm right more than I'm wrong, but with that being said, I'm going to be wrong. So maybe the market wants to do this, and if you're of that mindset, or maybe you're even more agnostic and somewhat neutral, but you just want to play the technicals pure, what you do is you buy support. You buy a pullback to 380, 280, just like yesterday. And recently I've been harping on every single pushback up to that 401 level, including yesterday in pre-market, has been a great shorting op. Hey, you could flip it around and say every pullback to 380, 280 has been a great area to go long for the last few months, especially for swing trading. I mean, you're back to where you started if you've been position trading, waiting for a breakout. But that's it. Let's not over complicate things here. That is support. If you are bullish, you buy support with a stop somewhat below, and you either swing to the top of the range or you hold for a breakout to new highs. If you are bearish, again, since now that we're on it, you can wait for a break of that support. Problem with intraday breaks is sometimes you get a whipsaw. Like this, you broke intraday, but then closed right back on it. And I think you can see that there. What I'm looking at, these skinny parts are called shadows on a candle, or when the shadow's down below, they call it a tail. And that means intraday we broke. But this is why when trading the daily time frames, the most important thing is how the candle closes the day. So those were on the daily frame successful defenses of support, both of those, and the market held. And so now the flip side is if you wait for a daily candlestick close, let's just say we dump today and everyone's panicked, longs that whatever reason, it doesn't matter. They start selling this market and then you close down here. Well, you got your daily close, but guess what? You also have a much less favorable entry. So there is no easy answer, and that's why I did say to someone, you know what, look, I have to be honest, I would start a position now because I think it's going to happen. I think there's enough in the charts to say that's going to happen. If it doesn't happen today, I think it'll happen next week. And that's, again, that'd be about a 2.5% drop. So that's where we could close today. We're down, 0.8% now, and I could easily see a drop down to that next support level in that trend line. And the one thing I wouldn't do if I didn't have any positions is go take a full short, all-in short position. So I like scaling in, and again, we'll see at the end of the day. Today's going to be has the potential to be an important day. We may close here, and then it doesn't tell me anything more than what I'm doing right now, other than saying, hey, look, we closed on support, so we're either going to probably gap up next week and defend that support and rally, or we can gap down. We'll see. I'll do an update towards the end of the day. But I do have some interesting charts to show you, and I also want to kind of share my mindset into this. Now, if I was a purely mechanical trader and just took any emotion or even not just emotion, but expectation as to what I think will happen, if I didn't do that, and some traders are like that, they're just purely mechanical, they have set rules and those rules don't get bent or violated, then I would probably be going long here. Why? I'll show you why. Well, first of all, that's one reason right there. Big support right here on the daily chart. If you bought it each and every time before. And also remember, it's not just support. Recently, it was also the previous reaction high, so it's another back test of the breakout. This breakout to new all-time highs that took out that previous high. So it's that, and traders buy back tests of support. Again, if you're a mechanical trader and you didn't buy a breakout, or you bought it but you wanted to add to it, then you buy also on the back test, and then with a stop somewhat below. Okay, so that's number one. But let's zoom down to the 60-minute charts. So usually, and almost always, in an uptrend, it's these 60-minute divergent lows that I get bullish. That's usually when I cover my shorts, especially if you get positive divergence on the 60-minute time frame and you've pulled back to support. We are at support right now. This was my first target from back here. I give you sell signal 1 here, sell signal 2 there. First target was hit right there, and it was support back then, even though we went through it, but it's still a level I've had on the chart, and it is support now because look, we went through it, and then we had since then another perfect reaction low right on it. So number one, we're at support. This first candle right here popped us a little bit down below there today. That's the first candle of the day. Gives you a 30-minute candle, even though it's an hourly chart, because there's 6.5 hours in a trading day. So they do the first hourly candle is from 9:30 to 10. The rest are all 60 minutes of trading. But that candle gave us a divergent low. It is what I call unconfirmed, meaning you need to see these PPO turn back up to confirm it. But again, that's a catalyst to new highs usually. Here was the last divergent low I pointed out way back here. And it proved to be the road to new highs. That little seemingly innocuous divergent low proved to be the catalyst for a rally of about over 16%. So there's that. Now, again, if I was mechanical, I would be going long here, or maybe wait until I saw that divergence confirmed, maybe a half position, or start to cover shorts. But again, I'm about to show you some other things in the charts that lead me to believe that we may burn through this. So this is where I can, in other words, I'm not rigid on my rules. I will adapt based on my expectations instead of reacting to what's already happened. All right. So, and one thing I'm looking for, and it's usually the signature of the beginning of a much deeper correction or a much larger rally after the market's been dropping, or a security, a stock, an index, a commodity, and that is to see divergence, a nice setup like this, fail and get burned through. In other words, the divergence never plays out. Maybe it even gets confirmed. They step in and then it gets sold out, and then that is a signature that things have changed. It tells me there's a change of character in the market, because usually dip buyers come in and follow up on those divergent lows. So that's it, guys. Basically, I suspect that divergence will be burned through, and then we're going to go down and hit at least my third and fourth target here on this near-term 60-minute chart. And if that happens, I think we'll also go down to those longer term I gave you on the futures. I think it's down here somewhere. That's my if things get ugly target. Let me just give it to you right now for QQQ. Everyone loves round numbers, so we'll make that 352. That's my if things get ugly target. This was a target from that previous trade down here. Okay, so 352, we'll call it T5 if you want. Let's just do that right now. And I'll let you know. We'll firm that up. If I think that's going to happen, you'll probably know that. We'll probably know it today or early next week. All right. And that's when, in other words, we're still on that hurricane watch right now, let's say, and we might issue a hurricane warning if we start to take out some of these supports and move down there. Okay, so before I leave QQQ, let me just show you the futures, and then I want to rifle through the FANG stocks real quick, and then I have some new charts to show you, things I haven't showed you in a little while here. All right, so here's the NQ, NASDAQ 100 futures, 60-minute chart, one of my favorite swing trading time frames. That is, again, see that? You have potential divergence right there. You have higher lows in these indicators about here, both the RSI and the PPO, with lower lows and prices, right? Just like right there, you had positive divergence. Just like right here, you had even bigger divergence led to a bigger rally. Small divergence, small rally, but still a rally that you didn't want to ride out if you were short, and you would have definitely wanted to be in if you were long. So that's that. However, one thing I will say, I prefer to see divergence at support, which we don't have, and we would have if we can keep that No, you know what? Here's the thing. If we come on down to this next support, which I think we're going to do, that divergence is likely to be taken out. So that's number one. Number two is we're coming off an even larger divergent high. We're coming off this was confirmed. Not only was it confirmed, but you had an impulsive rejection off that key 16,424-ish level, which is comparable to that 401 level on QQQ. And again, the impulsive nature of that says the sellers came in, the bulls got rejected at the line right there. They went up to try to dunk, and they got smacked down hard. And that's it's showing you what's going on in the market. There are a lot of people long selling, maybe shorts piling in. I actually prefer that. I want to believe, and it's hard because the data's lagged, that it's more long selling. I like to be the only guy short. When everybody else is short, that's when you want to get out. Why? Because that's when short squeezes happen. If you have high short interest in the market or a stock, shorts, I always say this, there's only one guaranteed buyer in the stock market of any security. One guaranteed buyer, and that are short sellers. Because if I short a stock, I have to at some point buy to cover my position. That's the only way to close it out. I must buy the stock. That puts buying pressure, and if a lot of people are buying at the same time, stocks go up. In other words, you can be the most ardent bull. You can be Jim Cramer on CNBC screaming, buy, 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 I'm bullish. But he doesn't have to buy. He might say he loves this stock, or I'm just metaphorically speaking, pick whoever you want. Hedge fund manager coming out and touting a company and might have all intentions to buy that company, but guess what? Second guesses it, doesn't end up buying it. So again, shorts are the only guaranteed buyers, and I'm going to show you some things in a second here that kind of show you the overall market conditions. So you have shorts, and you also have put and call by options traders, people buying and selling options, and I'm going to get to that in just 1 second. So there it is, guys. We are below those two previous lows, so we've broken the support, 15,773. We're a little bit below it, but not by a large margin. Sometimes, and this is how this market works, it's prone to these little whipsaws. We could snap back up, but if we don't, it's going to be bearish. The bulls need to step in now, and if they don't, well, they certainly, this is an even bigger level. This is a big support level to me, about 15,536. You have major reaction high there, a breakout and a back test here, and more recently, which is more importantly, a major reaction low. So again, if you are bullish looking for where to go long, there it is. You might still have the divergence here on the RSI. And if you are bearish, you want to see this level get taken out. And as I like to say, the redder the better. If you can get a solid 60-minute close below there, great. If you can get a daily close below there, even better. All right, there are your levels to watch, guys. And the big picture is this. We're in this trading range. That's also pretty good support, just cracking. We briefly dipped below it there, but that's the big level right there, 15,536 on NQ. All right, enough on that. Let's move on to ES. ES is the S&P 500 futures. This morning when I replied to some of the questions from yesterday's post, we didn't have, I gave you a chart, we didn't have divergence. Now we do actually, so I'm going to draw it in right here. There is that potential divergence, but again, I use the word potential. It's not confirmed. This PPO is a momentum indicator, and it is pointing lower. It needs to turn up soon, or it's going to continue lower, and it's going to burn through any potential divergence there. And remember, just like NQ, we're coming off a pretty big divergent high right here. In ES, we had divergent high 1, correction, pushed on, made a marginal new high. I talk about that all the time. Breakout is bullish on face value, but when it fails, that's very bearish because all the traders that took the breakout, all the long side traders, realized they were wrong. They had that rut row moment, and in this case, the selling was very impulsive, and that's usually what happens when a breakout fails. So there it is. That's pretty bearish, and we're flirting with support right now. This is my support zone here, runs down to about 4,600 right there in ES. We're a hair below it now, still enough if they want to rally it before the candle closes. But again, I don't think they will. I think we're coming down at least to this trend line. If you're active trader for ES, I think we'll get a bounce off that trend line right there. That trend line comes off the late September lows right here, and you can replicate it on your chart. But again, it's this divergent high that says we may go on and break it. And the other thing, I talk about change of character. I know I'm talking fast because I've seen a lot in the last few days. I want to get it all out there. Yesterday, remember in NQ, I pointed out a few support levels, and we did bounce off the first one, but the rest, we hardly got any reactions. See, we had a little tradable bounce there of about 0.6%. Then we just kept slicing through these support levels. We had a little bit of reaction here, but now we're moving lower. So this is a change of character. The dip buyers aren't really coming in anymore. They're standing aside, or they're being overwhelmed by sellers, those that are stepping in and buying. So this is a little bit of a change of the character in the market near term, and it will be an even bigger change of character, a bigger change of character if these divergences don't pan out. And let's just say that we come in there and we slice right through that trend line like it's not even there, or we slice right through this support. I should have a support line for you there as well, just like I had one on NQ. Let's put one right here. Obviously, you want to look at those previous reaction lows, but coming back a little farther, I have support about 444.60. 44.64 on ES. So my point is, if we just slice through that trend line like it's not even there, that would be quite bearish again. That's more of bear market or correction mode action. Let's just call it for that now. We can't even use the word. I know people bite my head off for even talking about a bear market right now, but all bear markets begin with a correction, and that correction ultimately morphs into a bear market. And if I thought I saw some things in the chart 6 months ago that said, hey, we could be looking at one, they're screaming right now, and I'm going to get to those indicators in a second. Let's just do that. Let's roll into my sentiment indicators. I'm sorry, before I do that, let me just once again be thorough here and show you some of the potential bullish things. Here's Apple, 60-minute chart. Coming up on support right now, 169.74 trendline support, but we're also coming off pretty fat divergent high. This is the first divergent high on the 60-minute chart. Since that one didn't do much. It played out for correction, but in time. Or we say securities can correct in one of two ways or a combination thereof. They can correct in price, meaning going down, or they can correct in time, meaning going sideways and work off any overbought conditions. So, and that was the previous one there. So there's Apple at support. What would be bearish and what would help me consider adding to my index shorts would be a break of that support, solid break, and a break of the trend line there, because we'd probably come all the way down to 157 at least in Apple. Microsoft, again, common theme here. A lot of these stocks, it's like the market recently put in divergent highs on the 60-minute charts. And they're heading lower. We're coming up on that previous reaction low there. There's potential divergence on Microsoft, but if we go much lower, it'll be burned through, and that's what I think will happen. I think we're heading down here to this support zone at minimum, and maybe more. Alphabet, again, common theme here, 60-minute chart, divergent high right there, and we've been stair-stepping lower. Amazon, here's one, again, nice potential for a bullish falling wedge pattern right here. That's what it's forming, so I need to point that out. And we could work our way down a little more. It could still play out, but if we eventually just burn through all those divergences and that nice bullish setup never materializes, that's going to be a change of character in the market. I could go on and on and on, but here's Tesla. Again, 60-minute divergent low. Last time we had positive divergence was right here. See that? And boom, we had a nice rally. Doesn't look like much with such a big move on this chart, but that was a 23% rally right there off that little divergent low. So we have bigger potential divergence, and it would be quite bearish again if the bulls do not step in and capitalize on that. It's going to show a change of character. We're also backfilling this gap. We're at support. That, like, again, if you're a bull right now and you're bullish on Tesla, I don't see why you don't buy here. I'm not buying it, but I want to point it out. Maybe I'll be wrong. Maybe it'll run up 909.63, and you can buy it with a relatively tight stop, or even better, I'd give it at least to this primary uptrend line right here, and that's not too much lower. Maybe it'll bounce from there. All right, those are all the things to watch. Now I'm just going to do one other thing. I'm going to walk it back longer term and show you what the weekly charts look like, and this factors into my analysis and where I will sometimes override what I'm seeing on shorter term charts. Here's Apple. I can roll back as long as we want to go on Apple, and what you can see here, you see these little letters DH, that means divergent high. Let me just show you what happened. These are on the weekly time frame. You don't get that often on Apple. You had negative divergence. You can see all marked on the indicators, and also usually at that you're going to see us run up to what I consider oversold on the weekly chart on Apple. I don't use a 70 level like default charting applications will give you a 70 is oversold. I'm sorry, overbought. To me, it's about 83.10. That's the magic number. It happened here. Now is a dot-com bubble back there. 82% drop in Apple. Divergent high, again, all the check marks. 42%, 62%. Little divergent highs, a series of them here, but they were consecutive divergent highs. They all led up to this final 45% drop. But you had 26, 15, 16. The divergence continued to build, and then the big one came, 45%. Again, doesn't look like much because this is log scaling. When you go back on a stock, and we're looking decades long, and one of the best performing stocks in history is right here, that drop is 45%. And if you were long, you would have either been stopped out or you would have been feeling the pain and losing sleep at night. So I respect these divergent highs, and I like to capitalize on them by shorting, either shorting Apple directly or the market. 34% drop, 39, 35, 21, and the divergence we had last time right here, gave us a 21% drop in Apple at that point. The same divergence is still in play. And not only is that divergence still in play, it's not even close to being at risk of being burned through. It could ultimately, maybe we're in some super bull market, comparable to the 90s or 1929. But right now, like I said, where these indicators are lagging so much, and we're coming off these extreme overbought levels, that this is indicative of a big drop coming in Apple that's going to measure well into the double digits, and somewhere where, we'll focus on that another time. Point of this wasn't to cover Apple. It'll speak to the markets, being that's the biggest component. That is now a $3 trillion company, and it has the biggest impact on the S&P 500 and the NASDAQ 100. Where's a long-term target? This primary trend line I have right here. That would be about a 60% drop in Apple. But let's move on. That's not what I'm calling for right now. It's certainly possible based on the charts, but first things first. This stock is just coming off all-time highs. Got a lot of work to do, and I'll always update that one when I cover the big FANG stocks. There's Microsoft. Again, same story. I'm not going to spend time covering each and every one, but you can see the big drops, steep divergence, negative divergence, and in the past, these divergent highs have resulted in double-digit corrections. So there's also a trend line in which to trigger a sell signal. We already had a sell signal via bearish engulfing candlestick right here about 3-4 weeks ago, confirmed with a red candle. We went sideways for a week, and now we're looking to print another red, aka confirming candle. And then if and when this trend line goes, that is a more powerful longer term sell signal, or it'll just follow up on that sell signal. And so this is how the market looks, because these guys are the market. It would be virtually impossible to see any or all of these, and they move in tandem anyways. They move in unison, and it's not because they have similar business models. Some of them have a completely different business models. Some of their things overlap, but it's the fact that they're so heavily indexed. This is the market we live in today. This is not 1970 or even 1980 or early 90s anymore. There's so much indexing going on that when things start going down and the spigot or the tide turns and goes the other way, money comes out of the market. It's coming out of the top weighted components. And you sell QQQ, if you fire off an order and you have $100,000 in QQQ and you sell it, they have to then turn around and of that, Apple is, let's see, of that 100,000 you just sold or you pulled out of your index fund. Where are my weightings? I had them somewhere, maybe on the daily chart. Here it is. 11% of that, or $11,000, comes out of Apple, and that's how that works. So, okay, moving on. Amazon, same thing. Amazon, great company. We all know that. They're here to stay. They're not going away anytime soon. But you can see when it puts in these divergent highs, it's simple. And I'm going back on a long-term weekly chart, 36%, 14, 32, 32. And we had divergence from this point here, started building right here in this little sideways trading range. Steep, big divergence. That's indicative of a large drop, probably going to come back to this trend line here. And not only that, we had a couple false breakouts of this sideways trading range. We're back down in the range, so drop down below there. So that's from the highs. You're going to see a total correction, I think, of Amazon. Whether the top is in now, or we're going to go on and make a marginal new high and maybe top sometime next year. But if we did it from where that recent high was and we hit it around this time, that's about a 33% drop in Amazon. So again, work to be done because it's still in a bull trend. We don't have any sell signals. We didn't have any bearish engulfings there. You did have the failed breakout, but that's it. I'm just showing you the technical posture of these market leading stocks. Tesla, you want to short any one of the market leading stocks now. This is one of the big five now. This one's going to have a lot of room to fall. Big divergence here. The last time we had divergence on the weekly chart was, I'm going to measure it out for you. The drop was about 55%. So this one lost more than half its value. It was in this trading range, had a divergent high. That was a 55% drop off that divergent high. Off this divergent high right here, the drop was about 51%. So it stands to reason this one could easily do that again. In fact, I have a target right there, a support level 463, and that'd be about a 60% drop. I think that's a likely target. Minimum, if you want to swing it down, this would be my first swing or trend target all the way down here to about 568, and that's about a 50% drop. So let's just color that up, and we'll revisit this at some point in the future. And that's it. So there it is. Okay, so in summary, it's still anybody's game. We are at support. QQQ gap down to, and it's trading at support right now. So certainly not an all-in moment to be short, at least at this time. You can go, if you're a bull, you can go aggressively long right now and just keep your stops tight. However, just remember, today's Friday. So if you go aggressively long right now, you're going to have to go long over the weekend, and anything can happen. Futures can turn around and go down sharply over Sunday night. We could gap down in the morning, and that gap could bypass any well-placed stop. So right now, let me keep it simple. It's not a time to be aggressively, long or short, in my opinion. You can certainly go one way or the other, and then just pick it up next week. Avoid that weekend gap potential, especially if you trade futures. And then you can add to your positions next week, or subtract. If you're wrong and the market goes against your position, and then you don't get clobbered. All right, so next up, we're going to show, I'm going to cover a few different sentiment indicators. I've talked ad nauseum about market breadth. I mean, I did a 40-something minute video on all my different breadth indicators. We're going to keep this one simple. I've got about not even half a dozen indicators here talking about market sentiment, mostly. A couple of them are market internals. All righty, this one is the CPCE. And that is the equity put to call ratio. So it measures the ratio of put buying to call buying on individual stocks. The CPC only does index, or the CPCI is for indexes, index options, and the CPC is the total put to call ratio. I like them all, but here I'm showing you this one now, the equity only put to call ratio, and we're looking at weekly time. So this is on the black lines, that shows you what the put to call ratio is. And when the put to call ratio is very low, it shows you there's a very low put buying compared to call buying. And what does that mean? Obviously, everyone's bullish. A call is a bullish bet. You buy a call on a stock, you're betting the stock's going to go higher. You buy a put, you're betting it's going to go down, or you're hedging a long position. So when this ratio falls, there's other levels. This is where you get down to this extreme, and usually corrections follow when it gets that low. However, that's not what we're using the chart for. This particular chart right now I'm using for, I put a line here that I have, and that line is just over, it's about 0.62, so about a ratio of about 0.62, and that seems to be the magic number going back as long as I can do it here. When I put a 100 period EMA on here, that's what MA 100 means. When it drops down to this level, there's a delayed reaction once you hit that level. And again, I like to use the 100-day moving average. Why? Because see how erratic this is? Looks like a funky EKG, right? Up, down, and there's spikes. So what a moving average does, the reason traders use them, it smooths out and it kind of gets the trend of everything there. And that's what we're doing here. So when the 100-day moving average falls down to that level, it shows persistent bullishness, meaning a low put to call ratio. And then you can see here the initial tag happened there, and that was back in the middle of 2006, and it took a little bit over a year. Because again, these are not timing indicators. They're very, very far from an exact timing indicator. It is showing you conditions in the market. In those conditions, we all know this. Excessive bullishness can continue for some time, and it can get even more bullish, and that's what tends to happen. Higher prices beget more buying, more bullishness, and then things get irrational. There's a disconnect. Markets get overvalued, or market conditions change, and then the correction set in. So back in 2006, we hit that level. We stayed on it for a while. We stayed persistently bullish right there, and then it started to rise, and then finally it was 56% drop in the S&P 500. We didn't hit it again until 2011. That was early on, and then it took a couple months, but we had one of the biggest drops, about a 22% drop. Things got normal again. We hit it again. Extreme complacency. Again, that measures bullishness falling to that level. Initial tag was right here. It took a while. It took a good 6 months or so. And then we had what I refer to as a deer market. That's neither bull nor bear. We went sideways for about a year and a half almost. But within it, we had about 16% corrections, even more in some of the other indexes. So again, you get too bullish, and it's contrary. If everybody's bullish, nobody's left to buy. It means everybody's already in, and then that's when the corrections come. And then most importantly, recently, and I've highlighted this back here a couple months ago, we hit that level, and look at this. I've never even seen this. It's going back as far as I can put that this indicator and overlay that 100 period EMA. We're well below that, and that shows extreme complacency. extreme bullishness. So and without any correction yet. So and like I said back here, it can take a while, especially the bigger tops. They just keep getting more and more bullish, and then that leads to an even bigger drop. So I know, super bearish stuff. Right now, the economy is firing on all cylinders. Everybody's buying everything. There's, especially where I'm from, Southwest Florida. I mean, my goodness, the builders are out. I need to do a redecking on my dock. They're almost a year out before they can even get to work, and the price gouging is insane right now. The prices to do anything, both labor, material costs, and again, what I'm saying is everything's hunky dory rosy, but that's how all bull markets top. And just like bear markets, they end. There's a saying it's always darkest just before the dawn. People think the world's going to come to an end, and it looks that way. And it looked that way back here with COVID, and it looked that way back there in 2009. And that's when it's over. And usually that's when everybody gets bearish, and you get to these extremes up here. All right, so that's that. Let's not talk it anymore. It's just that thing's flashing red flags all over the place. There's a couple more indicators I'll show you, and we'll wrap it up. Okay, here's another one. This is the CPC. Nope, that give you the CPCE. Let me pull the CPC. That's the same one, equity only put to call ratio. Okay, hit the pause button, and I'm not sure if I covered any of this. I'm just going to loop over again. I realized the video was paused, but this is the CPCE, and it shows you here the when you want to buy and when you want to sell. And you can see it's very, very simple. I color coded it here. This is when we have extreme bearishness or fear, or when you're at this green line. The level's roughly about 1.13. Again, that is excessive put buying over call buying. And let's just look at it. Back here, this was the great bear market, the great recession, and you can see we had a major low back in the fourth quarter of 2018. That was a huge rally, and that was marked by that spike in the CPCE. You wanted to cover your shorts and go long. You would have been stopped out almost certainly if you were short. I remember aiming that rally. It was there in the charts as well. There were other buy signals, and then boom, it said go back short for the next leg down. And then when the bear market ended, it ended with another spike there. So if you this is 401k type stuff as well. You buy these spikes, and these are the best buying ops in years. And then what happens is, well, let me just show you another one. That bear market or sideways market from 2015 to 2016, that ended with dual spikes right there. One of the best buying ops in years. And then that fourth quarter drop in 2018, remember we had a bear market and many indexes dropped over 20%. The S&P came very close. That was also signaled. That said buy it at the bottom right there. We hit that spike. And then again, you guys remember COVID? I'm sure you do. When COVID hit, February to March, 6 weeks, the market dropped 36%. Guess what? Told you everybody got too bearish too fast, and that was again the best buying signal. So these were the best buying ops over the last decade or more, over a decade. And likewise, this is also why I talk about during strong corrections in bear markets, that's when I start looking for bottoms and signs like this. And likewise, in the last couple of years, with the market being up, ripping up higher, that's when I start looking for tops. And that's why my videos talk about the potential for downside and long-term indicators and all those things. Because when you're in a bull market, nobody needs to tell you you're in a bull market. We need to look for when to get out of that bull market or when to short it. So where is that? It's right here. And you can see these tops. This thing, again, this is one of my best indicators. I have a red line right there at about 0.38, and that shows extreme bullishness. When the put to call ratio drops to that level, you had it right here. Boom! Look what you would have. That was the biggest drop early on in the bull market. Boom! Fired again there. Big drop. Boom, fired right here years later. It didn't even come close, but everybody got super bullish for some reason in mid 2014, and boom, right when they got that bullish, big correction came. And I circled this because we made a marginal high, and that bullishness there really led to this multi-year sideways, about 2 years sideways trading with a couple big corrections in there. And then we haven't seen this. My indicator, it's been firing persistently. Again, these are daily lines here, daily bars, and it pop, 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 pop. That's why I started highlighting it and talking about it here. And so here's the thing. It's not that this indicator hasn't worked. Only time will tell. If the market continues much higher and this thing moves away from there, then it didn't work. It was a false signal, and this indicator is not as accurate as it has been for many, many years. However, I talk about this, a lot of times it's a one and done reading, but sometimes you get clusters, and this just simply shows you an extended period of persistent bullishness. Only time will tell if it's going to play out or not. So that's one indicator I wanted to show you, and we're still coming fresh off those levels right there. So still a cluster of persistent bullish readings. And the last one I'm going to show you here, this is sort of ties into those breadth indicators I showed you the other day, but I had this one here. It's actually I have two more. I want to show you Apple and this one. This is QQQ, and what I have down below are the NASDAQ percentage percentage of stocks trading above their 50-day moving average and the percentage of stocks trading their 200. And I did cover this in a recent video. Again, you can see these divergences, each and every one without fail, were followed by corrections. 25%, 18%, that was about 5, 6%, 12, 13, 24, 31, 15, 13. But here's the thing. So this 15% one right here, we had that was actually our divergence line right there. There was our little divergence and gave it a little 15%. The divergence got bigger. Same divergence. Oh, take that back. Nope, take that back, because we didn't have it on the 200, but we did on the 50. Got bigger, and then a 12%. This is where we've been diverging since on both the 50 and 200 from this point right here. This let me erase that line right here, and this is big divergence, and that's indicative of a big drop. So again, it's just about every breadth indicator, sentiment indicator you look at. They're not timing indicators, they're just showing you conditions that exist in the market right now. And then last but not least, we'll wrap the video up with Apple. Apple, again, the only $3 trillion company out there, and by far the biggest weighted stock in the S&P 500, NASDAQ 100. So where it goes, the indexes go. There's no two ways about that. And you can see here what I have on this chart is here's Apple's stock price right here. It's on log scaling, so these are big moves in here. And then I have, it says here, corrections have followed divergent highs, as well as tags of this blue line. So I have two things here. I have all the negative divergences between the percentage that Apple's trading above its 200-day moving average right here. That's this line down below. I made a custom indicator that shows me in percentage terms how far is a stock above its 200-day moving average. And you can see this seems to be, I put a blue line here because that's usually the magic number. Sometimes in crazy bull markets you reach these extremes like this, and like you did here, and those extremes in themselves are usually followed by corrections, 23%. But more so what I look for is when you start getting divergence on that indicator. So Apple was very strong there. It was about 45% above its 200-day moving average. Had a little correction, pushed on, made a new high, marginal new high, but it put in some solid negative divergence on that indicator, or that condition. Again, percent it was above 200-day. Divergent high, and they're all marked. So that one resulted in a 45% correction, 14.5, or we'll call that 15, 9, 13, 45. Again, this one had divergence right there. The big drops come from when you hit this line, the blue line again, about 30, whatever that is there, 30 something, and negative divergence. Negative divergence, push up to that level, 10% drop, and then an even bigger one. I don't know why I didn't measure that. I must have missed that because the divergence kept going at that point. Sometimes I need to update these charts, and we had that bigger drop there. Then we put in a divergent high right here, hit the level as well, that blue dotted line, 39.5%. We hit it again right here and put in negative divergence right towards the end, 35.5% drop. We had an extreme spike here, and that was followed by a 25% drop. We hit it again here, followed by a 20% drop. But here's what I want to show you. From this point right here, we've been diverging now. Big. This is the biggest divergence we've ever seen. And again, the percentage that Apple was trading above its 200-day moving average. We had an extreme thrust here. Thank you, Powell. Throwing all the money into the markets. Gave that huge run up, put Apple way above its 200-day, which by the way is the blue line here. So you can see also, you can see how far it was above there. And now we have really big divergence. Again, the scope of this divergence is usually indicative to the move that's going to follow. So that's it. Some of my best indicators. Everything I just spent the latter part of this video on, all these indicators are, again, not timing indicators. These things, may not play out. That I would be very, very surprised, especially how much all these indicators are lagging, how strong the divergence is, how much room there is for more upside in the market, and have those divergences get even larger and not be taken out. That's number one. But they are not timing indicators. So to get in there and to get in, if you want to capture that next big 20, 30, 40% plus drop in the market or in Apple or any of these names, you need to start with what I began the video with. We need to see those levels taken out. We need those additional sell signals. We need to see the weekly charts confirm some of the recent sell signals. We need to see some new trend lines, some larger trend lines that haven't been taken out yet, or support levels on the market leading stocks. And if and as that all that happens in the coming weeks here or months, it'll increase the case again that we're looking at not just another 5, 8, 10, 12% correction like we've seen, or even 20% like we've seen in recent years, but something much larger. So we'll end it here. Last thing I'll say, again, I know that right now it absolutely doesn't look like that based on how strong the economy is, but again, that's how all stocks top. That's how the market tops, on rosy good news. Otherwise it wouldn't be up where it is. So just keep that in mind. The news flows will follow. The charts will lead. They'll show you first where the market's going, where a stock's going, and only after it's gone down do the headlines start to change. Do they start to retrofit or match the headlines up with what's going on. Okay guys, long video, but that's everything I wanted to get out to you, except I'll do updates on crude oil, natural gas, crypto, sugar, and all the other trade ideas in a little bit. I'm talking a lot about the markets lately, but remember, the markets, or the index, a short or a long on the indexes, is only one position out of what should be many, half dozen or more. So I'll get to the other trade ideas shortly. This has been Randy Finney with the Right Side of the Chart. Have a great day.